Good afternoon, and welcome to the Cirrus Market Outlook. This is Satya Pradhuman, Director of Research. Every quarter, we put out a report that's titled The Dispatch, and a lot of the exhibits coming from today's remarks will be taken directly out of that. There'll be some references as well to several other reports. I'll try to flag those as we go. The title of this report, Soft Landing and Interest Rate Risk, point to value tilt. And today what I'm going to do is really walk through several key points that's defending why we think there is a real change underway. Year to date, we've seen a dramatic breakaway of the largest or so 7 technology or technology-related stocks. The rest of the market has really lagged quite a bit. We've seen over a 1,000 basis point edge favoring large caps over small. A massive gap has also opened between large growth and small growth. To really no surprise, we've seen a very tough relative performance environment for active management. So some of these changes that we think might be underway not only will affect, I think, the rest of the year, but this goes well into 2024. So here we're going to frame out really the risk to leadership, the extended FANG growth run as we've seen the year close. Also, we like to be able to defend the profit cycle is stabilizing and begin to freely use the term soft landing. We've already been doing it, but I think this is still a jump ball in some people's minds, and I think we need to sort of address that. In terms of this value rotation, how severe, what are the contours, what are the side effects? So we'll walk through some of those items. One critical area, though, is this area of active management that our model performance numbers really echo what we're seeing in the real world. The active large cap growth results have been just downright awful. And I'll try to walk through some of those, some of the reasonings behind that and why there is, I think, legitimate reason for hopes going forward here for this to turn around. In addition to that, outside of the US, we definitely want to focus a little bit on the global profit cycle as well. And this leads us to sort of like the ABC strategy, as we've been calling it, or the anything but China story. So we'll walk through, what are the key implications of what we're seeing there, this divergence between the East and the West. And then finally, focus a little bit on one of the special topics on housing, home builders. We'll try to walk through what's been going on there. A lot of weakness given the recent interest rate moves, but to some degree, we think there's still a real opportunity to buy and not sell. So let me start really with the punchline, and that is, if we're right about some sort of a value rotation, our active strategies are going to have to recognize that valuations become more important as we go forward here. And so this, when we look at the active blends that the Cirrus blends that we're running, we run traditionally 3 active growth blends. So they are aggressive growth, GARP, and quality growth. Given what we're thinking, the shift that we're going to be making is really moving from a quality growth bias, which we've had for well over 18 months, almost 2 years, I think, that now shifts over to the GARP model. Similarly, in the value arena, what we're looking at is moving from a quality value to a relative value stance. And so at the end of the day, if valuations matter more, the GARP model has a higher weighting in terms of valuation exposures. We are going to lose some of the emphasis on earnings visibility, but at the same time, we put a little bit more focus on business momentum and more on valuations. The aggressive growth model has probably worked the best here. Trending factors have really taken off in the larger growth arena. We think if we're right about this potential rotation of value, this strategy becomes probably the laggard in the marketplace, to be seen. And then the other question, though, is that if we're beginning to lean value, why not deep value? Why not go pure? And the reality, though, is that what we're not coming out of is a deep recession. What we're coming out of potentially is a slowing in the profit cycle, never going into a recession, and therefore looking to some sort of profit expansion. In other words, whatever we're seeing on the profit cycle, it is less weak, potentially stabilizing, not dramatic, sort of deep cyclical bounces. So the deep value model really doesn't deserve this sort of focus that you could see if we were indeed looking at a true blue deep value sort of rotation. That's not really the situation as far as we see it here. The cover chart from the report, we thought this was definitely cover worthy in using a Seinfeld phrase. The idea here is that interest rates. We've seen a bear market in the bear bond market in the last few months. If you look at the purple curve, it's basically backed up. It's gone from, like, let's say at the low end of this year at about 3.4 to about 4.5, 4.6, even climbed up well into 4.8 temporarily. This is over 100 basis point back up in the 10-year. What we've seen overlaid here is the growth to value bias. At the heart of this is that in the last several months, as this has intensified, we've seen the market really give back probably a net in the larger cap arena 5%. And we've started to see some quiet rotations going on, not consistently, but roughly about a 300 basis point, 400 basis point advantage of value over small cap growth. So that is something that is that's very different from the way the first 6 months of the year had turned. And so the question is, what's the likelihood that this is just a fluke and, very short term in nature? Another way to think about this is the market's run so much, you had to have some sort of a pause. Really, if we think about this, several things come to mind. Number one, we really do have historically tight labor markets. What you're seeing right now with the amount of strikes, these are all basically pricing effects on a service economy. And so it's exactly why the tone of the Fed has been to be a lot more wary and really watchful over the economic comparisons that are coming through. So this idea about an interest rate relief, we've been using that term relief quite a bit this year, which is this sense that since the first quarter, I also think probably the real reason that it really triggered this sort of like nifty 7 type of move was that there was a hope in the first quarter that the US economy was going to plunge into a recession, given the historic rate of tightening that the Fed had really pursued. Several quarters later, we're like, that is not a rate cut is not a 23 event. Potentially it's a 24 event, but at this point it may get pushed out into the back half of 24, probably not even the first half of 24. But moral of the story is that this interest rate risk is going to remain in place. And in order for high multiples to really stay aloft, you really need a supportive interest rate backdrop. In terms of some of the macro elements, what you're looking at here in terms of the liquidity regime models that we've got, that model continues to signal that the Fed, we really are on a tightening of liquidity, not a relaxing of that. And so even if the Fed interest rate hikes potentially go on pause, they're still continuing to shrink their balance sheets. What we have found historically is that more liquidity is very good for risk assets. So this is something that puts a pause on how excessive multiples can trade. In other words, if we're looking at a profit cycle that's stabilizing, a period in which rates will not come to the rescue, you're looking to more of an earnings-driven market. And when we look to the earnings profit cycle, what we're seeing is some sort of stabilization that's underway. When we look at the revenue curves, we've seen really a rotation or a fade in the top line growth across markets, notably in the US as well. But what we're also beginning to recognize is that the forecast, the forward year estimates are starting to stabilize. We've had an 18-month window of where earnings estimates had really come off sharply, probably for the right reasons. Markets also reacted accordingly in the last year and a half. But what we're now starting to witness is more of a stabilization in the estimates, fewer cuts in estimates, and quietly a few increased estimates as well. So in general, this is a backdrop that does stack well for fundamentals to start working. And so this is really a very different picture than what we were looking at 18 months ago. And so we do have to sort of embed that in the portfolio strategy that we look at. So the question is, can this continue? Are we looking at where the profit cycle is stabilizing, likely to come back? One of the leading indicators of this is also the capital markets when we look at funding. And in terms of most of the credit market, sort of observations we've made, to some degree, it's been surprisingly resilient, given the record amount of global, central bank action that we've seen in the last year and a half. One would think that the credit market, the spreads should be a lot worse than where they are. But what we've recognized, though, is that most of the developed markets, what we witnessed was the initial backup in credit markets. In fact, as they initially started to tighten, we did see this really dramatic backup in spreads, going up to, in terms of the US, going up to almost like 600 basis points, and then rallying back to roughly about a 400 basis point spread. So the moral of the story is that we do not have the sort of really easy money, unusually low spread levels of 300 basis points going back a few years. But we are in a world where the spreads are actually quite favorable for business to get capital to really chase after growth projects. So this, I think, harks well for the earnings cycle to come, that if firms can get credit, this is a good thing. You tend to get better earnings. Markets like earnings, full stop. Let's not overthink, what drives the market. Profitability slows, markets get noisy, profitability improves, investors chase companies. And so when we look a little bit deeper into the credit market situation, what's been surprising is that the spreads beyond the winter sort of hiatus with the regional bank concerns that was raised in the first quarter, beyond that moment, we've seen a steady relaxing of concerns. One of the areas we'll talk about a little later is also the housing area. This is probably one of the most important pulses on, the housing market, also consumer credit. What we are recognizing is that even in the housing sectors, besides banking, we're seeing all those subcomponents, those spreads have also rallied in accordingly. So we think this is good. This is really constructive for the economic backdrop. The idea that profits are stabilizing, we don't have that fear factor that would drive us to the safest companies with the most visible earnings and most likely the highest multiples. So as that reverses course, this is really what's like creating a backdrop for this rotation. Now, let me go more into empirically why we're making these claims, because this is a backdrop. There are a lot of moving pieces and parts. One of the signals that we've built out in our work, in our toolkit, is the style oscillator. Simply put, this signal basically moves between a growth overweight and a value overweight. And what you'll notice is really in the last year or so, we've had a severe growth overweight. No surprise, given the concerns of the fallout in the economy, given the reversal of central bank liquidity. That has steadily been in this growth camp. And then most notably in the last 3-4 months, we've really seen a reversal in the growth bias, where we're now, at least in this style reading, we're now in a lean value world. This indicator is updated every month. It can be found in our monthly report called Signals. And that's really one of our macro reports that puts a bunch of things in there, such as stocks versus bonds, small versus large, growth versus value. And what this is suggesting empirically is that we do have a world in where this is suggesting we begin to add valuation sensitivity to the portfolios. And, just to be really clear, we're not suggesting that growth managers become value overnight and so on. What I think makes sense, though, is that if you are a growth manager, you're probably likely to focus more on your valuation than you had the last 18 months. And if this is right, that allows you to outperform the growth benchmarks. And for the value manager, I think if you've been on your heels looking at the most defensive names in the slowdown in the cycle, this allows you to sort of relax that assumption and maybe begin to look more, really play offense in the value box. So the question is, what else comes of this moment? What are the implications if we're right? One of the areas that's sort of tough to accept is this idea that in a value cycle, we typically see more of a lower returns marketplace. And this is, in other words, there really is no such thing as a free lunch. The idea that more fundamentals are going to matter, earnings drive or share prices, that's great stuff, right? Because if you're looking at financial statements, you're looking at the company's business line, that should help you figure out where to go. The reality, though, is that from a macro stance and interest rate stance, really a weaker economy, which allows for a more really constructive interest rate backdrop, also allows for multiple expansion markets. And empirically, if you look back at the last 30 years or so, what you'll see is that the market as a whole tends to have a higher annualized return in a growth cycle zone. In the value zone, what we find is that the market as a whole tends to have a lower absolute return. Now, the reality is that, to no surprise, what we've done here to measure this type of statistic is to look at the last 30 years, define, really call out multi-periods of performance of growth over value, and that became the growth samples and vice versa. The reality in the last 30 years, though, you've had a very growth-heavy world because you've had a disinflationary period that lasted multi-decades. That said, though, I think empirically this is probably closer to the truth that if you are in a world where the profit cycle is stable to accelerating, there's a good chance not only do you not have an interest rate supportive backdrop, but an adverse interest rate cycle where the Fed is potentially concerned with overheating of the economy. And that's really where you get the potential pause on gains in the market, less of a multiple expansion story. So this idea of a value run does suggest more of an active manager benefit. It also does suggest, though, it's a lower returns market that we really should be framing in our outlook. In terms of the other knock-on effects, one other model that we run monthly is the size premium model. And what we're beginning to notice is that there was a serious large cap overweight going back the last 12, 18, 24 months. And what we're noticing is some sort of a reversal of that, maybe albeit quite slow, but we have moved out of an extreme overweight in large caps, and now we're in a sort of lean large moment. So things are changing. I do think that this growth value rotation tends to line up with the size premium. In other words, if you're moving more towards a value market, I think, not to overgeneralize, but one logical takeaway is that you're probably looking at a broader market, more of a favorable, smaller cap arena. So to some degree, this is, to no surprise, I think this is very consistent with what we're seeing. In terms of other effects, though, and this has been published in several other reports, what we're also likely to see is an intra-growth rotation. In other words, when we look at critical pockets of growth managers holdings, the benchmark for that matter, technology and healthcare tends to be the standout exposures. What we think will happen is that if we do begin to see this reversal from extreme valuations, we're looking at probably one of the most sizable valuation gaps between technology and healthcare. We think if you're running a growth fund, you don't have a choice but to remain exposed to these sectors. If you're forced to lower the technology exposures with the most extreme expensive stocks, by definition, you're going to incrementally increase your holdings to healthcare. So tactically, I think this is just the math of it. The other fallout, though, is that if valuations really matter, growth managers will also cheat on the size premium. What we're also realizing is the large cap growth arena, the valuation in that segment against small cap growth is also at a near 20, 30-year extreme. So what we've got here is really a market in which you've got this sort of like super concentrated Nifty 7 sort of moment. And conversely, you've got competing sectors like healthcare that are looking very, very discounted. And at the same time, we can also look down cap because we've got some extreme valuations. And one of the most extreme, partially driven by just the largest 7 or so names, is the large growth, small growth trade-off. So that's something to think about. In addition to that, industrials, we've made a really good case in the last 18 months on why there should be this trade-off in CapEx between technology spending accelerating at the expense, really technology spending slowing as industrial spending accelerates. We for a bunch of reasons, I won't go into it in this call, but we've published a lot on this. The idea, though, is that CapEx industrials, the spending is accelerating. And our case that we've made historically is that if that were to occur, it will occur at the expense of CapEx technology. That's exactly what we're seeing. We've written quite a bit about it. We've also created CapEx industrial baskets, active baskets, to reflect how to position in those spaces. This sector has actually put up decent numbers for the year. It's been, however, overlooked just by the dramatic gains seen in some of the larger technology names. And so this chapter, I think, that we're moving into signals quite a bit of change. And as a result, I do think this is something that we have to sort of think about as we're looking at holdings and exposures in the portfolio. So one of the implications of a break in leadership, if we're right, is that what is the fallout on markets? Because intellectually, if you do get leadership names to really begin to lag, that will probably be more violent than less. Market volatility should rise. This is especially true if you've got oversized weights of leadership in the S&P 500, which is pretty much where we are. And so the question is, how violent is this going to be if we're right? And the bottom line, I think, is that probably less dramatic than what the normal course would look like. And I'll do my best to defend it. But the idea here is that if the profit cycle is on the mend, investors aren't going to run away from risk assets. And importantly, some of our critical risk-taking measures are not flashing red. And so take, for instance, the stock bond allocation model that we published each month in the Signals report. That model had a record high exposure into the 80% going back maybe 18 months ago. What we're seeing is that number has faded this year from the 70 handle down to about a 60% equity allocation. But make no mistake about it, this is an overweight in equities still. So even with the run we've seen, what we're saying is that this model, and it's driven by a number of things such as credit spreads, which you understand is actually not terrible. It's driven by a bunch of relative valuation comparisons. This would suggest that the risk assets are still on the menu. And as a result, even if we do get a sort of like intra-market rotation or a break in leadership, this is not telling us to rush to a cash or a bond allocation moment. Additionally, risk-taking behavior, it has stabilized, and it's recently been on the mend. But at the heart of this, what we're not seeing is a market that's super speculative, where risk appetite readings are well beyond normal. And so this is, I think, really important to recognize that the downside risks tend to be most extreme when you have a very heightened speculative market. So the question is why? Given the dramatic gains of the 7 or so stocks and the AI run, why aren't these readings more excessive? And at the heart of this model is the idea that you've had a lot of stocks punished. And so what you're looking at is a 10% or so performance gap between the large stock index and the smaller names. In other words, a bunch of stocks have been punished in this marketplace. And so this risk appetite reading is telling us that, as dramatic as the performance spreads are, we're not sort of a flashing red moment with this measure as well. And then the other very, very important topic that people really tend to focus on is the amount of crowding. Why? Because it's just, it's at a gut level. It's a really important thing to understand that if just a handful of stocks are leading the market, how far, are all market participants going to chase those names? And so our polarization measure is a pretty neat proxy for measuring this. And this model is basically more of a valuation-driven model. We basically we look at the valuations of the most expensive stocks. And that reading is benign. I'm surprised by this. I think a few months ago, about 2-3 months ago, we did see this reading get to an extreme. And actually, we've also seen a fairly soft market in the last 2 or 3 months. I'm not trying to relate one to the other. I think the bond market had plenty to do with the pullback in the last few weeks and months. But the heart of this model is also telling us that if I look at the leadership basket is, it's got, in the large cap arena, it's got plenty of technology in there, but it's also quite diverse. It's got the other larger components of exposure are in industrials and also healthcare. And so we're not at a point where this was like the early pandemic moment where interest rates went practically to zero, and it was like a 70% exposure to technology and healthcare. The most speculative form of healthcare for that matter. So it is a very different makeup of leadership. So if there is change underway, I don't think there's such more of a, like the classic traditional break. It just doesn't seem like it's in the cards. I think we're still sort of struck though by the dramatic moves in the 10-year. And that's really still that's the driving narrative right now in terms of absolute returns. But some of these components within the market microstructure, they're not flashing red. And I think that's super important to just bear in mind. And so if we move about to this change, I raised the subject about active versus passive. It's just been a terrible year for active managers, especially in the growth arena, especially in the larger cap arena. And so when we look at our own active blends, because I think they're a good proxy for some of the active results that are out there, what you'll notice is that our large cap GARP model, as an example, has outperformed the growth benchmark in the last year by about 15%. And when we look at the large cap growth proxy has lagged by about 500 basis points, whereas in the small cap growth arena has actually led its benchmark by about 15%. So the large cap managers have really been under fire. This gap is fairly extreme. They should move together, or at least more in sync. When we look to the value side, we see a very different story. We see in the smaller cap arena, our active blends are outperforming sharply by about 1,500 basis points. And in fact, even in the large cap side, they're also outperforming by about 500 basis points. So the bottom line though is what we've seen that's made life very painful clearly are the sort of like very select stocks that have hit, near a double for the year, and the rest of the marketplace. And so when you think about active management in their portfolios, They tend to be a lot more diverse. They're looking to protect on risk. They're looking for fundamental growth, reasonable valuations. A number of those elements just were not on the menu this year. And so as we look for this turn, if there's a broadening, I do think this is probably going to be one of the most dramatic reversals we're likely to see, where the active results begin to quietly work. If we look to leadership currently in the larger cap camp versus the smaller cap arena, what you're going to notice is an interesting makeup where the technology exposure is in the upper arena, no surprise, right? It's practically, it's a little bit over a third in our trending basket. This is how we would define leadership, to just look at a 1-year trend, measure the top decile of those names, and then look at the sector exposures. What's important, though, is healthcare is there as well in a sizable way. But if you'll notice that the industrial exposure is roughly about a 19-20% exposure in large cap camp. So what this is suggesting is that the market is more diverse underneath it. And if we're right, the fundamentals are actually moving in that direction. And so that would potentially support why you don't have this dramatic fallout, but also it also says that as we get this rotation, evaluations begin to matter, the active manager will come back to the forefront. And we've already been witnessing a much more diverse mid and small cap portfolio exposure. And down cap, the market's been more fundamentally driven. That explains a little bit of why the smaller cap results have actually been quite good for the year. They're active, I should say. The benchmark itself has really been punished. So in terms of shifting gears a bit, I wanted to talk a little bit about the global picture and how this sort of fits into the US strategy. And probably the one thing that's really jumped out at us has been really this, as we call it, the ABC strategy, or put another way, anything but China strategy. When we look at the profit cycle globally, what we've begun to recognize, as we stated earlier, is that the top line growth for most Western markets is that we're starting to see some sort of stabilization or a less slowdown as we get each reporting period. When we juxtapose that to China, what we're seeing is this fallout in growth, and it seems to be accelerating. Importantly, when we look to the forward year projections, what we're also seeing is that the estimates have really begun to reverse course in the West. The US is an example. Europe is also an example. And the Chinese estimates, though, even though they've been fairly defensive, we continue to see more of a downward pressure there. So the bottom line is that this profit cycle story is stabilizing across markets, but we're recognizing a very divergent picture when you look at the East versus West comparisons. Importantly, this is filtering into the other risk measures that we watch. When we look at risk appetites, Japan, Asia Pacific, risk appetites have been on the downtrend. When we look in the West, the US, Europe, UK, those markets, the risk appetites have been benign to being raised. So this is, I think, something that goes part and parcel to this profit cycle story, that if markets tend to chase, earnings seem to be stabilizing in the West. They're not stabilizing. There's still really a lot of challenges when we look at the Chinese economy and the fallout to its neighbors. And so this will continue to drive benchmark patterns. One of the important subjects we published back in late last year, was this idea about, do you know what's in your emerging market index? And so if China is like an exception to the story, does it end up inadvertently causing the emerging market indices to look weaker than they are? Because at the same time, as much as that's been going on, if you look at Latin America as an example, what we'll see are fairly strong gains, partly because of the commodities and partly because of nearshoring. So I think the story is a lot more complex, but fast forward, what we're recognizing across the planet is a stabilization in the profit cycle. The East, driven really by that Chinese comparisons, are quite a contrast. So this ABC strategy, we think, is will continue to work, and investors, global investors, are looking for ways to retaining their emerging market exposure without potentially by lowering the Chinese component in that. And so we think that will likely continue as we go through into 24. And then one other topic I wanted to cover briefly is this area on housing. And I think it deserves some attention just because we've seen the home builders and related firms really, really rally this year. It's been the other groups that have been working. And in the last few weeks, we've seen a sharp pullback. And a lot of that, as I've said earlier, is the interest rate picture is really driving some of this. However, in terms of strategy, we always want to be looking out into the next 12, 18 months in terms of where growth is going to come from. And when we look at this market, there are some conflicting signals. And part of it has to do with what we're looking at in terms of mortgage rates, that mortgage rates are now probably likely to hit 7.5%, 8%. Radically different from what we saw just back in 18 months ago. Versus the world in the credit markets, where, as I said earlier, housing-related, consumer-related credit spreads are actually benign. They're rallying. And so what this would suggest is that really this is a story of two very different parts. One is the front end of what the consumer is facing, and the other end is that we've got sort of like the institutional investors seeing something different. So the question is, what is it? And to some degree, what we've interpreted this as is just more of a secular trend towards housing, whether it be the post-pandemic moment, the underbuilding driven by the last great recession, and the fact that we've got these other corporate behaviors such as remote work. So these things have changed the sort of like view of what a home is worth potentially. So we think there's a lot more going on here that is not just an interest rate story. Historically, you can witness periods in where housing demand continue to go up, even in the face of much higher mortgage rates than we're seeing today if you go back to the 80s and 90s. So one important thing at a fundamental level is that we've also been able to tie credit spreads to margins, which is important, right? Because if your cost of funding is going up, by definition, your cash flows are going to get worse. And this bears out nicely where we look at home builder credit spreads versus their margins, and they tend to move in a contrary fashion. In other words, credit spreads that ease tend to allow margins to climb. And so what we continue to witness is a fairly stable to very favorable high yield market in the consumer high yield area. So this is something that we think is important, that we've seen this pullback, but we think this is more of a tactical move, more of a reaction to the very dramatic sell-off in the bond market, unlikely to be long-lasting. All right, so we've covered a lot, but I want to make sure that I leave you with the main takeaways. One, there is a soft landing. I think we can defend the interest rate risk that will surface because of profit stabilizing is telling us to become more valuation sensitive. We're looking, when we notice the earnings estimates, that is certainly leading us to more of a fundamental focus on the menu. One of the realities, unfortunately, of a value cycle, though, is that we're looking at more of a lower absolute returns marketplace. Historically, at least, that lines up. Intellectually, I think it lines up perfectly. The reality here is that if we are in a world where the Fed is not going to be on our side, unlike the last 30 years, what do? We focus on the fundamentals. We focus on earnings. And so you don't get the free lunch or the multiple expansion driven by rates, but you do chase earnings. And so this is more of a fundamental market that I think we migrate to. Active management under fire. I think we do get some relief here as we close this year and as we go into 24. And then a couple of things globally, what we're noticing in the profit cycle story that supports the US view is the idea that across the regions, we're seeing a stabilizing in the forward estimates, which tells us that the analysts on the ground are seeing something in terms of an improvement, not a deterioration. Again, the Chinese experience is quite different. And then finally, the focus on home builders. The strategy, the active strategy in terms of how we're delivering portfolios, how we're looking at portfolios, we are looking broadly to become more valuation sensitive in some of the bespoke work we deliver. Clearly, we've been in this camp to suggest strongly to be in our quality growth arena. Here, we're going to begin to make the shift towards a GARP focus. And for our value clients, moving away from the high earnings visibility focus we've had the last couple of years, moving more into a relative value portfolio, which will allow for more of a cyclical bias. So that pretty much concludes my remarks. Thank you very much for joining us today. And this will be available as a replay as well. Thank you.